Luke Ellis, the CEO of Man Group, is my guest. Luke, thank you very much for your patience. Regrettably, people can't see us live, but they can hear us live. And so I think it would be appropriate, because we had been interrupted by the back and forth of the video, to rewind and go back to the beginning of our conversation. At the risk of sounding a little repetitive, I think it's appropriate, particularly for those who are now just joining us. Man Group, for those who don't know, is one of the world's premier quantitative investing firms. And because of your expertise in systematic strategies, but furthermore, what powers those systematic strategies, the analysis, the gathering and analysis of pricing data, I wanted to talk to you about one of the more fascinating developments in markets over the past few months, and that is the rise of the day trading phenomenon, typified by Davey Day Trader Global, otherwise known by his real name, Dave Portnoy, of Barstool Sports. Luke, is this day trading phenomenon something that Man Group is trying to wrap its arms around, measure, understand, and perhaps profit from?
It's certainly something that we're trying to wrap our arms around and understand what was going on. And then what we're trying to do is to understand its impact on market prices and patterns in markets, and to make sure that our models adapt for that. It's not that we are per se trying to make money out of the day traders, and we don't actually do anything that's sort of very high frequency. So we're not in and out within a day in the stuff we do. We leave that to the Virtus and Citadels of the world. But whenever you get a new actor come into a market, they tend to change the market behavior. They tend to change some of the market price patterns. And normally what happens, the first phase is difficult for the models because it takes them a while to realize there's a new participant in the market. But then gradually they will start to identify what's changing, and then we'll try to take advantage of the new patterns, the new way markets are trading with the new participants. It's a bit like, if you're playing a game of poker and a new player comes to the table, you don't understand that player's tells, you don't understand the way they choose to bet or not bet. And so it's quite hard as a professional to play poker against somebody that you haven't seen before. But the longer that you play with them, the more you can adapt your style of playing to try to take advantage of the opportunities that it creates.
I'm going to run with your poker analogy. Thus far, it appears that this new cohort, the day trading community, has taken a few hands from the pros at the table. Is that something that can continue, or are participants like yourselves going to figure out what the patterns are, and eventually these new occupants of the seats at the table are going to lose their whatever advantage they may have, because their trading is less predictable than others might be?
I think over time we would all expect that valuations do matter. That doesn't mean value is the only thing that can work, but valuations do matter. Relative price performance matters. The amount something's overbought or oversold matters, so on and so forth. And so over time, alpha harvesters, which is a way of thinking of what we do, our job is to generate alpha for our clients. And, the more inefficient actors there are in a market, the more opportunity there is for generating alpha. So, you're absolutely right. This day trading phenomena really came in at a perfect moment. They came in at a place where the professional community was, very keen to fade the bounce in the market, and the sort of day trading community took the market up and took a number of the darlings of the market up a long way. And, that's been a difficult environment for a lot of professionals. But bit by bit, I think you're seeing some of the more of the natural realism coming in, and more of the opportunity to trade things for people like us, for models like ours, to adapt to take advantage of what's happening in the current market.
Luke, if you look back over the past 3.5 months and analyze performance since, say, the first week of March, when things really began to change in markets, who's fared better, man or machine?
I never think of it as one or the other. The reality is there are no humans investing in the market without using machines today, whether it's because that's how they get their information via Bloomberg, whether it's the way they study their portfolio, whether, now in Bloomberg you can get so much information about a stock. So humans are armed by machines in the same way in our quantitative business. It's humans that are building the models that are then running on the machine. So, I don't think it's one against the other. I think what you saw, if you wanted a general sort of characterization, I think that directional strategies had a better time of the first half of the crisis. And relative value type of strategies had a pretty tough time because, first you had the big sell-off and then you had the recovery in things which, the question of whether they got government money or didn't get government money is outside the scope of normal valuations. But I think over time, the people that have done best are the ones who were able to remain calm and continue following a structured process. Machines are good at that, but there are plenty of people in the machine, the quant world, who have got the wrong side of these trades.
Interesting that you should make that observation. We have a chart that we prepared ahead of time that does show how well CTAs, which we might call trend following strategies, did relative to the broader stock market in the initial phase of the crisis, and then haven't done so well as of late. Trend following is a strategy in some respects based on factors, or at least it falls into the same camp. And Luke, if I'm not mistaken, there have been at least 2 major factor rotations since February, one toward the beginning of April and one again toward the beginning of June. And it raises a question for many whether there's a new volatility regime in factor land. Is there?
So I think we would say by historical standards, there might have been 15 factor rotations in the course of the month. And so you've definitely seen a significant increase in volatility of relative performance of factors. And I think that has been something that has been building for a while and has been really exacerbated in the last few months. And it's basically, when people first started factor investing, it was very much an alpha source. It was a differentiation source. If you end up with a place where everybody is factor investing, then it becomes purely a risk factor. And what you've seen over the last few years is significant increases in the amount of factor investing, such that a lot of factor investing is now really a risk factor. And once it becomes a risk factor, it's then you tend to get these rapid changes in relative performance in the factors, and you tend to you have to manage it as a risk rather than creating treating it as an opportunity.
What are the consequences of that? Is there anything? I suppose the better question might be: are there any consequences to that beyond more volatility?
Well, I think one of the things of it is you have to avoid thinking that the moves that we saw beginning of June, there was a big spike for value, and then it was all given back incredibly rapidly to momentum. What one has to stop thinking of those as the signs of big changes in market environment, and to recognize that they're much more likely technical features within the market. Sort of everybody wants value to, well, maybe not everybody, the growth managers don't, but the sort of, there's a general conversation you hear around investing all the time about, must be finally time for value to come back. I think that we're likely to see a lot of false dawns given the amount of money that will switch from a momentum index to a value index, then back to a momentum index. So we're likely to see a lot of false dawns. And personally, I don't think you get a significant change in value until we see a change in the interest rate regime and the inflation regime. And that doesn't feel like it's happening anytime soon.
Don't tell Cliff Asmus. Luke, if in fact you're right and factors have evolved beyond alpha generation tools and portfolio attribution tools and become in and of themselves risk management tools, does that mean that they are thoroughly commoditized and you can't actually use factors as an alpha tool any longer?
I think that the simple version of the factors has definitely become commoditized, and you can use it as a portfolio construction tool in a form of diversification, which is a risk management thing. But I think we are strong believers that the world gets more efficient every day. Information becomes more available every day. There's more information on Bloomberg, and you can download every day. And what that means is that there is a natural decay in the power of any historic alpha source. And what's important in order to keep generating alpha on a forward-looking basis is you need to keep creating, you need to keep innovating, you need to be finding new things which are not over time priced in. So I'm sure that there will at some point be a rally in value. And some people will say, look, I told you so all the time. But you have to look at it in what the risk-adjusted return was over time. And, I think a lot of it now would be noise. So, we think you have to move to a much more sophisticated level of understanding cross-sectional value within sectors and then neutralizing for other effects within there and looking at each stage for, okay, here's what's in the price. What are the things that the average investor is not looking at? What is it that is different rather than just because I want something to go up or down?
That reminds me of the term, if you will, that people throw at quantitative investing, which is to say arms race. He who has the most data and the fastest computers wins. With what you just said, Luke, as the context, what do you believe is worth the expense of time and money today to differentiate what man is doing from your competition, if you will, to gain an edge?
I think everything in the technology sphere is an arms race. We can see that in the data provision business where there's a very small number of super successful businesses. You could see it in the social media space, and you could see it in gradually happening in quant investing. I think the thing that you missed when you talked about that is, that buying bigger and bigger compute power that's easy, and there's no real barrier to entry there. Getting more data, there's really not that much of a barrier to entry anymore there because the data is incredibly freely available. Sort of not an hour in the day doesn't go by without some data provider contacting me saying they've got a new WYSI data set. The scarce resource is people who can understand how to program those computers, who can understand how to model and do the math in a both sophisticated and also an intellectually honest way. Intellectual honesty, recognizing really what is alpha and what is likely noise, not data mining. With all of these data sets, the temptation to over data mine is incredible. And so, we think that the scarce resource which you need to hoard, to use sort of traditional metrics about it, is the intelligence, is the experience, is the quants and the technologists. And so, we're at a point today where half the firm is using Python every day, in anger. It's a coding language, but it just gives a sense of how much of the firm is really, how much of what we're investing in is into the intellectual firepower, which enables you to be successful in doing quantitative things.
As you know, Luke, some big hedge funds generated exceptional returns in March, in April, and even in May, and that may even be continuing, although I haven't seen June numbers yet because the month isn't over. Many of those hedge funds are not systematic players, they're discretionary players. Does that in any way validate the discretionary hedge fund as an investment vehicle, or does it say something else?
Look, I think that there have always been and there will always be exceptional discretionary fund managers. You know, a third of what we do at MAD is discretionary fund management, and you know, we've had some very good returns out of this. You know, it seems to me one of the things is with, you know, so it's fantastic, and you know, some of the people who've done brilliantly are friends, and I'm delighted for them, and you know, I think their success is great. It doesn't mean everybody can be a discretionary fund manager or discretionary hedge fund manager and be successful. You know, it's only the very exceptional ones that can generate the significant returns and can remain calm as everything is going crazy around them in order to see the patterns that are there that they're trying to take advantage of. You know, their process, that there's nobody who really does any of this stuff purely by gut feel. Their gut feel is a series of processes and rules that they've developed over time, which are going on in the back of their head all the time to then take advantage. So I'm a believer in discretionary hedge funds. You know, I think actually the overall hedge fund business, in 2008, the hedge fund business did a pretty poor job on average. This time around, the hedge fund business has done a pretty decent job and has, you know, delivered the diversifying returns that clients want. And, you know, I think on average, it's been a pretty decent outcome there.
Luke, after the last crisis, the financial crisis, of course, in 2008, 2009, there was regulation, lots of it, in fact, and mostly it was regulation of the banking industry. What I'd like to know from you is, what, if any, regulatory response do you see coming out of this crisis?
So I think the big driver for regulatory response is governments, regulators, central banks hate losing control. And when you looked at the financial crisis, you know, the governments and the regulators and the central banks lost control, and they just had to throw money at the problem that was created by the banks. Then out of that came limits on leverage. Out of that came risk stress testing that basically meant that banks had to run with a more conservative business in many different ways. And out of it came some personal liability for the people running banks for what went on. What's happened this time is the banks have been a source of stability in all of this. And, you know, you would say that the more conservative balance sheets and the more conservative business models that they run today, that has augured well through this crisis. What we've seen is that in the 10 years since the last crisis, an awful lot of the corporate community has moved to maximum leverage that they can possibly get onto their balance sheet. So maximum financial leverage, but also maximum operational gearing and minimum resilience. And so, you know, you can say that the shock came out of left field, but the reality was we saw a large number of companies, both public and private, that couldn't withstand even a 1-month shock to their business, and certainly not a 3-month shock to their business. And so governments and central banks have been forced to throw enormous amounts of money at the problem. I think coming out of this, and obviously in the US, there's a question of the election and politics, but generally coming out of this, I think you're going to see, either driven by shareholders or more likely driven by regulation, that there will be limits on the amount of leverage that companies can run, financial leverage. There'll be a drive to some form of stress testing of businesses to make sure that they have less operational gearing so that they're able to withstand things. You can think of, we moved to a just-in-time manufacturing world, which starts as a good idea, reducing inventories, but got to a place where you had major manufacturers who had 1 hour of spare parts and supplies in order to do their manufacturing, which meant they couldn't withstand any sort of shock at all. I think coming out of this, it's likely that companies are going to, either of their own choice or be forced to run with similar type of stress tests that banks have, but not just around financial constraints. And so to me, I understand, you've had a number of very smart people, including my old friend Manny, on this series of talks talking about how the economy, the sort of GDP could be back to 2019 levels by the end of 2021. I think that's very credible. But I think the question of what you will get in terms of net earnings through to shareholders, I think it's very hard to see that will be back to the same levels that we were before, because even if revenue gets back to the same level, the reality is there is going to be a force to having a higher cost. You're going to have to have more capital, so it's a higher cost of capital, less return for shareholders. I think you're going to have to run with more inventory, more of that sort of thing. And, I think there is going to be a drive to paying more to critical workers, low-end workers. We've all discovered that the Amazon delivery driver is critical to our survival. And so out of all of that, what's left for shareholders out of the same earnings stream just doesn't look like it can be as much to me as we come out the other side of this event.
There's a natural tension, of course, Luke, between profits and, costs, if you will. What I'm trying to get at is the public was ready to accept regulation of Wall Street because Wall Street had done so much, to anger the public and to anger politicians. In this case, the anger you describe is certainly felt at the central bank level. It might even be felt at the governing level. But do you think the public is willing to tolerate the kind of regulation you describe if it's going to result in fewer jobs? Because companies are going to have to make that decision between profits and jobs.
I'm not sure that it results in fewer jobs. So I think that's, the reality is the public anger wasn't directed at the banks until we were coming out of the crisis. And right now we're right in the middle of the crisis and people are focused on survival in the end. But, I think the idea that, we have taken Friedman's idea of primacy of shareholders to an extreme level. And we've basically, you can pick all sorts of companies, and I'll try and avoid choosing an individual name, but where they ran their business in such a geared fashion that at the first sign of trouble, a mixture of governments have been forced to throw a lot of money at them, and they've laid off an enormous number of workers, or they would have laid them off if it wasn't for government supporting them and paying for them in the meantime. I think that you're going to see governments refusing to write that free put to shareholders in the future, and they're going to charge them for the put. And I think at the same time, you're going to find that companies that look after their employees and don't go to minimum standards are going to find it much easier to get and hold on to the high quality employees that they want. And actually, we've all talked about ESG a lot in the last few years. It's clients and therefore shareholders talk about ESG a lot. I think most of the energy has been focused on the E part of that and trying to help the environment. But the social elements are really important. And, I don't think there's anything at odds with having a long-term successful business which looks after its employees and doesn't sit there going, well, I need to fire a load of people to maximize my 1 quarter earnings. I don't have to do a buyback in order to boost the shares for a few months, that actually I can think about running the company with a 5 and a 10-year view. And in that process, you will hang on to certain, more employees. You will want to provide better conditions to your employees, because actually in the long run, it is more effective and you end up with a more valuable business over time.
I might call that, Luke, an inspiring idea, and I hope others are listening. Luke, I want to thank you very much for joining us here at Invest Global. Ladies and gentlemen, that is Luke Ellis. He is the CEO of Man Group.